Well, this is it where you've gotten almost to the end. You still have the final, obviously, to do. You may have some homework to turn in and term paper. Fair enough. Get that all in as soon as you can, but certainly before taking the final. Finals can be given through the RP Now system, which is administered by the e-learning folks. And so what we're going to do now is we're going to review some of the items just to kind of hit some of the highlights of the course, hit kind of baseline of knowledge and some of the things. 72 questions on this exam, so again, it's not, open book won't work for you. Just not enough time to get 72 questions in 90 minutes. But anyway, I'll jump right in. So some of the things we're going to talk about. This slide, obviously, it's just going to get boring. It's not going to rotate around. I've actually got copy of the test, and I'll kind of go through and not read the questions, but kind of hit the intent of each question. So if you can understand that, you're going to be in pretty good shape. Okay, so when we talk about insurance, we talk about a beneficiary. What's the beneficiary? Beneficiary is the person who's going to get the money, right? Obviously, it's life insurance, so you're not here. Whoever the life insurance was for, that's the insured person. The beneficiary or beneficiaries, whatever, can be more than one, are going to be the people that are going to benefit from that. So they are the ones designated to receive those funds. We talk about different things with bonds. We talk about bonds that can be exchanged, perhaps for common stock. Like I said, I don't hold bonds. Well, I mean, I might again, but I've held them in the past. But of late, and this will be relate to other questions. If interest rates are quite low, which they have been for the past whatever number of years, you would not necessarily want to be holding bonds because as yields go up on new bonds that are being issued, your old bond would not be as attractive. Nobody's going to want to buy it, and you could sell it in the secondary market, or you could, get suboptimum interest and just stubbornly hold on to it, but that wouldn't be nearly as good as you having a uh, you know bond with a higher interest rate. So that's why bond rates and interest rates, it's all tied together. But anyway, certain bonds can be exchanged for common stock or any kind of stock. Um, Depends on how it's written. But anyway, that would be a conversion, a convertible bond. Bad thing on bonds is a call feature, meaning that let's say it's a different time, different place, and interest rates are high right now. Let's say interest rates are, and they probably will be here in a while. Let's say interest rates are paying 9, 10%, and then things normalize, and drops down to where they can sell new bonds for only 3 or 4%. Well, the company that's carrying those doesn't necessarily want to honor that deal if there's a call feature. And so they'll exercise that call feature, which means they go to you and they say, hey, here's your money back. The deal's off, and we're calling this bond, and it's over. So a call feature is not a good thing for you because it just means that it limits just how potentially financially advantageous that bond can be for you. Uh, when we talk about insurance policies, and really, this applies to any kind of contract, an addendum to a contract. In this case, in the insurance business, they usually talk about a rider. But I used to be involved in contract riders with concerts and stuff, and those would be the things where they say, we need whatever, M&Ms in the dressing room, no brown ones or no whatever, just weird stuff. It's basically an additional thing to a contract. In an insurance sense, it means that something that's kind of out of the ordinary on a insurance contract, and that might definitely be in your favor if you've got, say, some expensive camera equipment or some expensive jewelry or whatever. You'd want to make sure that those items are delineated, and typically that would be done by means of a rider. Um, Mutual funds. When you're buying mutual funds, There's both loaded funds that charge a commission and no load funds. Obviously, you're smart. Why would you pay a commission when you don't have to? 99%, I would say, of all the funds out there that are offered are commission free, meaning no load. So those are the ones to seek out. Because again, the commission would come off on the front end, so it'd be quite expensive for you, given the time value of money. Mutual fund investing stocks are rapidly growing. So rapidly growing would be growth, right? Um, other funds balanced would be anyway. It's all marketing. These names there's no necessary legal definition of these things. But if you see something growth, high growth, whatever, that entails companies that are growing fast versus maybe say an income fund. An income fund is typically a larger company that's paying a dividend. That's where the income comes from, the income by way of dividends. And then there's some other stuff. Mutual funds in the same industry. So that would be a sector fund. But there can also be different mutual funds are, it's up to the imagination of the people doing the marketing and the fund manager. They can concentrate however they want, um, with the idea that they're going to entice the maximum number of investors. So there will be funds that will concentrate in, say, biotech or defense or whatever, semiconductors or something like that. You can find all sorts of sector type funds. And then you can also find them geographically. But mutual funds are interesting in that way. Now, again, the reason why you typically get involved in mutual funds is to get some diversity. So now you're putting all in one sector. That's kind of anti-diversity. But, um, at least you're not all in one company. And that's the kind of diversity that mutual funds typically represent. So the next question just talks about mutual funds in general, the concept, the kind of the pooling of money of many investors, you know. It's an item. Now again, it's just underlying stock. So it's not insured by the FDIC, the Federal Depository Insurance Corporation. No real investments are. Bank things are typically invested up to maybe $250,000, but if we're getting to that point, well, we could get to that point, but anyway, $250,000. Hopefully, your portfolio, your nest egg will exceed that, and you're gonna have to get out there. Anyway, let's say you got some punk child goes out and finds some vacant house, advertises it on let's say Facebook or something. There's a huge party, the house gets destroyed. Well, it's your child, and that child was a minor. So, in insurance sense, that's called vicarious liability. You're responsible. So unfortunate. Anyway, let's say you're buying some stocks. Remember, we can do different orders. We can buy at market, which just means give me the price that it's selling for right now. We can do a limit order. A limit order would be it's trading, between 35 and 36 today. Well, I want to buy in the low end, so I'm going to put in a limit order to buy at 36. I mean 35. Sorry, I'm not stupid. So I'm going to buy on the lower end. If it touches that lower end where your order is, your order now becomes a market order and will execute hopefully quickly. And if it's a highly traded stock, Tesla, whatever, Alphabet, something like that, it's going to trade instantaneously because there's so much volume. But if it's a real slow, sluggish stock, there's a chance it might not execute right at that price. You can also get more complex. You can do stop limits, and I think I talked a little bit about a trailing stop and some of the other things. There's some cool stuff you can do, especially intraday with stocks that aren't necessarily available in mutual funds, where mutual funds are basically traded with the end of the day settling price. Stocks that sell for less than $1. Those are penny stocks, and it's just a category. But anyway, anytime you get these stocks that are super low priced, probably not SEC regulated, you're pretty much going to lose big time. There's reasons, they're going to say, oh, this is the next big thing and all the rest of that. But for the most part, if they don't, if they're not traded on the big exchanges, then they don't have to necessarily conform to the SEC guidelines, and the opportunities for fraud and pump and dump and all the rest of that are quite a bit higher. So dealing in stocks, already can be pretty much volatile enough and kind of exciting. Penny stocks are, yeah, you're probably not going to be the winner in that one. There's a lot of people in there who concentrate on that and more in the predatory sense, and just you as a casual investor coming in there and happening upon it is exceedingly rare to the point of being non-existent. Anyway, um, system that requires insurance companies operating in a state to provide coverage. So there's a state law for, in just about every, well, I think in every state, for liability insurance. You have to have insurance, not necessarily for your own car, but you have to have insurance for the liability, for the damage you may cause to somebody else. So that's viewed as a public good. It's also understood that the state will insure some pretty bad drivers. They'll suspend a guy with multiple DUIs. They'll take away their license at a certain point, but there's people have to work, and there's always a eagerness to get try and enable people to have driving privileges. And so what they'll do is they'll make the insurance companies that choose to operate within a state, a condition of them doing business within the state is they got to pick up some of these less than stellar drivers and offer them insurance. Now they don't have to offer them at a great price, but just the same, there probably is no price where it'd be economically viable to try and insure some of these folks. But anyway, they'll put those people in what they call an SR22. That's what it is here in Alaska. Other states, it's just called assigned risk. But assigned risk pool means that an insurance company for auto insurance, as a condition of doing business within the state, has to pick up some of those drivers. And so it works out, relatively well for the rest of us because at least these people have insurance, but does make insurance a bit more expensive since some of these people probably shouldn't be driving in the first place. A will is a specific document. All these other terms, living will, leather, they're just extraneous terms. A will has a specific meaning within a given state. A legal declaration of a person's mind and disposition. So it has to be signed, witnessed. It has to be, all those things. But it's has a specific meaning for just a will. And they just use that term alone, which is the way typically it should be used. There's a couple of problems in here. Here's a lady buying some stock. She buys for one price, sells for the other price, paid a commission. So how much money did she make? And how much was the commission? That comes off of the profits. And if she got dividends, well, then that obviously would be added back in. So it's just sort of a word problem. You'll figure those out. You won't need a calculator for the most part. You could, but and a calculator is permissible, but I think you'll be just fine, especially since this whole test is multiple choice. So this guy's thinking about investing in a high-risk company. So high risk and investing is not typically, those are not synonymous terms. Or whatever, they don't go together. High risk is speculation. And investing is not so much in the way of speculation. So this guy's looking for a quick turn. Yeah, that is a speculative type investment. So this lady, she's got an insurance company. she's got coverage, but she goes to the doctor and she still has some out-of-pocket expenses. Um, that would be a deductible, just the same as a car deductible, related to a copay, but not exactly the same. But anyway, so you know, let's say your charges are $5,000, and the insurance company gives you 4,500, and you got to come up with the other 500, and that would be your deductible. Um, so this one they're talking about uh, gold prices and international tensions, and so in a calm environment, gold prices are supposed to decline. So again, I've talked to you that this can be a bit more confusing because gold and silver are also industrial metals, which have industrial uses. So there could be a chance that, the economy's thriving and there's those metals are in high demand and the prices might actually go up or go sideways or whatever. So read the question, but know for the standard answer that and this actually predates crypto and other things that may have replaced gold in terms of a store of value. But anyway, gold being a store of value in quiet times, tranquil times, gold prices are supposed to decline. Estate planning, you're not there. You're so estate planning means this is post life, right? So, yep, it should, and any of these answers should include something about death. You do estate planning while you're alive, but all those activities that are going to be affected by it have to do with you being gone. Financial leverage. If you're talking leverage in investment purposes, that means you're borrowing money. So again, borrowing money isn't always bad. If you can basically rent money for a good price, it might behoove you. Now, if you're going to rent money for a good price and put it in crypto, that's probably not smart. Even the stock market, um, not smart. Put it in real estate, that's kind of the way it's done. So, anyway, um, but using leverage itself, when they talk about being leveraged, they're talking about borrowing money. Here's an individual. We're talking about retirement. What should they do? Obviously, start early and save whatever you can. So, assumptions about Medicare, assumptions about how long you're going to live. Um, Most of them aren't valid. What you do need to do, though, is you need to start saving and start saving as early as possible. And again, given the time value of money, those small amounts can grow into quite a bit more. Here's a lady, got a bunch of equipment, and they're talking about this addendum to the contract. So a rider, a floater, sometimes they'll call it also a floater. So even the answer says rider and floater. So if you know rider or floater, a floater is, yeah, that's probably more common in insurance parlance. A contract rider is um, fairly well understood as any kind of addendum, any kind of addition to a contract. This guy died without a will. Bad, bad. What did he do? He died intestate. Intestate means that he did not have a will. So he's still going to go to probate court. Probate is the state court that works on all this stuff, but the probate court's going to be faced with a task, which, anyway, not to be cynical, but you know how many of these government type things work, and it's probably not going to come out with the results you want. And if it does, it's probably going to be much delayed and much more expensive. Whereas if you just would have had a will, it would have been, just sort of a tick on the block. They would have approved it and off you go. And your beneficiaries or the people spelled out in the will actually get the money rather than the lawyers and the courts and everything else. This guy's got some assets. He's got all the documents, the legal process that it's going to go through. Just as I said, is going to be the probate court. Here's a mutual fund. I didn't talk too much about these in the course, but they're quite common. You'll see something for you guys. I don't know. It'll probably be life cycle, 2070 or something. What they try and do is these mutual fund companies will go with this idea that you should be in fairly aggressive investing, when you're young, and then less aggressive when you're middle aged, and then very conservative as you're about to retire. And they'll call that a life cycle fund, and they'll set some sort of target date, and the target date will normally be associated with your retirement. So anyway, they're pretty popular in terms of they're fairly easy to sell to people, so they like that. I don't know about that whole style thing. I don't know. I've always been in fairly risky stuff, which works out sometimes, doesn't. But the theory with the life cycle fund is that when you're quite old and you're going to be drawing out of that retirement fund, a huge drop might definitely affect your life, and you don't have that many years left for the market to recover. It's pretty much acknowledged that the market goes in cycles, and if it happens to be on a downward cycle and you're running out of years to live, that might have an effect on your lifestyle. So that's why they, push you into more conservative. But anyway, I think I'm more optimistic than that. Interest rates in the overall economy. You have a bond, so this is what I talked about back in the first part. A bond with a fixed interest rate. What's going to happen to that? So the interest rates in the economy are decreasing. So tough to do in this situation where interest rates were low, interest rates are now going up. So it's kind of different than the situation we had. Anyway, in this case, the value of the bond would increase if interest rates were going from higher to lower. But the situation we're in now, interest rates are going from lower to higher, so bond values would decrease. Anyway, read the question and kind of understand where it's coming from. And another question, very similar, so don't get these confused. Here's an interest rate rise. The corporate bond with the interest rate will decrease in value. So another one related to that. If you don't have a will at all, well, there's generic, state laws and probate court that will say, well, it all goes to the spouse, or there's no spouse, then it goes to the children in equal shares or something like that. And whatever, it's just a standard approach for people who don't have a will. So you can do better than that, have a will. Illiquidity. Illiquidity, especially in real estate, means that you can't easily convert that into cash quickly. So real estate is viewed as being very illiquid because it takes, months typically to turn that into cash, unless you're selling at a discount, and which point you're giving up that discount. So, why do you have life insurance? To replace the loss of the breadwinner, the person bringing in the money. So, if you have a spouse who doesn't work, do they need a great deal of life insurance? The financial answer would be no. Not that they're not going to be missed or emotional. We're not talking any of that. All we're talking is financial stuff. Now, again, though, it could be pretty devastating. Could have some financial implications if you have a stay-at-home spouse that's taking care of your, 5 children, and you're out making big money, and whatever they happen to die. Well, now, you're not going to be probably working as hard, or you're going to be having certainly some expenses that were covered. So, yeah, I mean, yeah, I'm kind of talking out both sides, but anyway, it's to cover the financial aspects of um, a death. So, another stock question. So they buy at one price, sell for another price. You can do that. Here's somebody looking for above average profits. Yeah, they're thinking their choices were defensive stock. Defensive stock is, I guess you could qualify, define something as a defensive stock, but it would be a stock that's probably not very volatile, that's maybe like, beer or bread or something that's probably going to do all right regardless of market conditions. People are still going to, drink, if not drink more, or eat the same amount of bread as they always did, as opposed to, some luxury item. But funny thing, COVID, yeah, the rich got richer, so maybe some of the yacht companies and stuff were good stocks in that market. Cyclical stock, that's a different thing. That's a stock that goes up and down based upon obviously cycles. So maybe, energy stocks might be cyclical. Small cap, that has to do with the capitalization. Here she said she's trying to get above average profits, which probably might be a small cap, but if they're just kind of a languishing small cap, that might not be indicative. Small cap might just be a small company that's staying small. A small cap that's aggressively growing would maybe fit into her wishes. A blue chip stock. A blue chip stock is typically, big blue chip companies, well established, you know. But again, it's kind of old economy, which actually has some risk to it. But here's one. They were looking for above average returns, and here's one that says growth stock. Well, that's the clear winner. So I'd go with growth stock over that, even that small cap, because it's the logical choice. Here's a guy bought a car with airbags. What's he doing about risk? He's reducing it, right? Is he avoiding the risk? No. You can't really avoid risk unless, and we're looking at a car insurance scheme here. The only way to avoid it is to not drive. Assuming risk would be transferring it to an insurance company. That's kind of related to shifting. But anyway, reducing risk would coincide with airbags. How do they figure out life insurance premiums? They look on the charts to see basically when you're going to die, and those are called mortality tables. So they can look at all your factors, and the more information, the better, as far as they're concerned. It's not good for you necessarily, but like I say, if they could have your genetic data, your medical history, but they'll go with simple things that they can normally get easily. Your age, do you smoke or not? What's your driving history? You got a couple DUIs or something like that, and they can come up with a pretty good estimate of when you're gonna die. But if they get more information, they can even fine tune it more. But anyway, that will all factor into their mortality table. Here's a person, they just young, making reasonable money. What would they look for long-term investment? Just like we talked about with the lifestyle fund. When they're young like that, you're going to be looking at growth funds, right? Because you can afford to take a little bit more risk. Where do most people get their health insurance? From their employer. So it's not, Medicaid is fairly big, Medicare, but Obamacare or Affordable Care Act, that's fairly small. We're talking less than 10% of the people. Most people get their health insurance through their employer, some sort of subsidized coverage. Which type of investment typically will get you 10% per year? It's not T-bills. It's not corporate bonds. It's the stock market. So, anytime you're going to get involved in a mutual fund, and I was talking about, how some of them have different strategies, what they're going to invest in, all that needs to be spelled out in the prospectus. And there's a legal requirement for that prospectus to be available to you. So do not invest in a mutual fund until you've read the prospectus and agree with it. And then if you see the mutual fund doing something different, well, they can't. That's not legal. And if they do, they're going to have, class action lawsuit initiated by, maybe started by you, but obviously it's going to be a class. So some other lawyer is going to put it all together and if they violate the prospectus. Um, Anytime we're talking about, so we were talking about T-bills and other things before, and I'm saying they're just not really investing because they're not keeping up with inflation. You're not making money, you're losing money. And oh, by the way, any money you do make is even going to be taxable, so it's going to be even less money. So all that is the reason why you're not making money is because of inflation risk. When investment does not keep up with prices that are increasing. So inflation risk is out there. It's more prevalent now, obviously. Annuity, what's an annuity mean? Well, and here in this test, we're going to be talking about just the insurance use of it. Annuity means a series of equal payments. And in terms of insurance, it can be defined as the opposite of life insurance. Because in life insurance, let's say you have an annuity that pays you, $100 a month for the rest of your life. Well, the longer you live, the more money you get. So that's what makes it the opposite of life insurance. If you die next week, well, you only got $100. If you live another 30 years, you got a pretty good chunk of money. So the only way you collect on life insurance is by dying. So, from a financial sense, it benefits you to die, but obviously there's the fact that you're dead and can't spend the money. It makes that not a good option. Um, This is a lady. She's investing in stocks. She's getting mail asking her to sign over her votes. Because remember, if you're a shareholder, you actually have voting rights within a corporation. Now, if there's 1 million shares of stock outstanding and you've got 12, we're not going to burn up a whole lot of postage and nobody's going to give you an opportunity to speak because it's, you only have 12. So what typically you'll get in the mail is a proxy, and that will be assigning your votes over to somebody else to vote on your behalf. So you can choose your proxy, and it's almost like a campaign thing where they'll tell you what their outlook is. So and this could be interesting, especially with Twitter this week. With Elon Musk getting involved, you're probably going to learn a little bit about how shareholders work, and it's kind of interesting because he actually had the opportunity to be on the board. But remember when I talked about all the SEC requirements and other things that officers of a corporation, a publicly traded corporation, have to comply with, or else they're have legal issues. He would have had to comply with all that stuff. He would have to do, even though, let's say, whatever his intent is, but let's say he wanted to screw Twitter and put them completely out of business. That is not a fiduciary position for somebody sitting on the board of Twitter. He would, I don't know that he'd go to jail, but he'd certainly get sued when the stockholders say, hey, you are sitting on the board of a publicly traded corporation. You have to act in the best interest of the stockholders. And putting the company out of business does not improve our financial position. Now, he, just being a stockholder and not a board member, he's a private citizen who just happens to own a bunch of shares. So if he happens to manipulate his shares to punish Twitter or do whatever he wants, there's nothing to be said. So anyway, we'll see what happens. But Twitter's in a little bit more dangerous position now that he's not doesn't have this fiduciary interest to the shareholders since he's not on their board. Anyway, way off on a tangent. Okay, so this guy's making a bunch of money. Um, he's got all kinds of bills, but what's he going to do? Just like you will, he's going to put some money aside for himself. He's going to pay himself first. He's going to make his investment program a bill and just get that out of the way rather than, foolishly wait and see what's left over at the end of the month. Okay, this guy's giving some money to he's got a match going on with his company he works for, right? And I guess it's a she in this case. She puts up 5%, and the company will match that with 5%. You need to do that. If your company has got a 401k, let's say you want to do your investment program and you're putting money away and you've already started it with your own private mutual fund company and outside of the business, and you go to work for this company and they've got kind of the same thing. They've got their own 401k and they've got a match. Well, you might have to suspend your other investment to make sure you get that company one completely covered, because that company one comes with a match. If you could do both, that's great. But anytime you hear the word match, make sure you're taking advantage of it, or else you're working for less money. And also keep in mind, find out what the vesting process is. And what that means is, in most cases, they're matching your 5% with their 5%. Well, if you quit in 2 months, they take their 5% back. If you stay there 3 years, and then decide to leave, maybe you get 50% of that. You stay there 5 years. Anyway, it's however the company has it set up, but it's important to know because it may affect how quickly you change companies because there may be a financial, um, you know, it may be to your financial detriment to switch companies too quickly. And they know that. That's why they've got that written in there. They want to retain you kind of under duress. Okay, negligence. If you are in an insurance situation and you're found negligent, that's not good. I mean, liability is one thing. That means that it's your fault. Negligent means not only is it your fault, but it's because you failed to take ordinary and reasonable care. So, if you get in a traffic accident, that's not a great thing. If you get a traffic accident because you're rip roaring drunk, that's showing some negligence, right? And so they're going to hit you a little harder. Same thing around your home. If somebody hurts themselves, walks into a wall or something, well, that's kind of their fault. It may still be your house. You may still get sued, but it's probably not going to go too far. But if they happen to walk into a hole that you had, dug and didn't mark and didn't cover up, and that that's gonna end up in a worse situation for you. You'll be found negligent. Um, Limited partnerships. So I touched on this on that last one. In this case, it's a real estate investment, but any sort of investment venture. Anytime you hear the word limited partnership, make sure you know what that means and know what your limits are. And typically it means that you can't get involved in the direct management. If you're a limited partner in some investment thing and they're putting up some buildings, they're doing something really stupid, you have to be very careful about how you point this out to the people involved in the investment without, you know, being construed as you now managing that project and increasing your liability. Peril. So we talked a fair amount about insurance. Perils are things. What you want ideally for insurance is all perils, right? Let's say your house gets destroyed, and let's say it could be fire, flood, earthquake, whatever. You would just want your house back. You don't care. You want all perils insurance that is going to cover it regardless of what the cause of that damage is. Keep in mind, that's typically not going to be available to you. Since flood insurance is a separate program that you might have opted for, you might not have opted for. Also, earthquake insurance, I would venture to guess that most of you don't have it because it is prohibitively expensive and what it covers is kind of not so much. So a lot of people found out that they didn't necessarily have earthquake insurance during that last earthquake. So anyway, but the perils are the hail, fire, those are the things that are going to cause the damage. The cause of the possible loss. Here, ladies buying some shares in the company. Company with long history of paying dividends. Okay, so remember I talked about growth things. Those are companies that are growing and they're not paying dividends. They're reinvesting them because they're growing the company. But long established companies, those are going to be the ones paying dividends, which is income, right? So some sort of income fund. We talked about liability. We talked about renter's insurance a little bit. If you have renter's insurance, it doesn't cover the structure because it's not your structure, right? It covers your personal property in there. So it's typically pretty inexpensive because it just covers that. Here's a lady, another insurance situation. Got a coffee maker that doesn't work right. It's malfunctioning, likely to start fires. That's a hazard. And if you allow that to, it's all interrelated. So the peril is going to be fire because that's probably what's going to happen if she doesn't take care of it. And if she doesn't take care of it, then obviously she's negligent. And since it happened under her watch, well, then she's liable. So it all goes back to related terms. Here's a guy looking at his investment options, trying to figure out what to do, and he's deciding to spread his money around. Some in cash, some in this kind of investments, some large caps, small caps. That's all called diversification, where you're going to not put all your eggs in one basket. Here's a question back when we were talking about stock prices. We were talking about charts and all that, and I talked about beta. Beta is when we talk about volatility in stocks, it's kind of hard to say something is volatile, non-volatile, because when the whole market is moving, it's like the ocean or a tide. You need something something to measure against since everything's moving. And so what they've defined beta as the volatility of the S&P 500. So if something is a beta 1.5, then it's 1.5 times more volatile than the S&P. If it's 0.5, then it's 50% as volatile than the S&P. So by definition, the beta of the S&P, the Standard & Poor's 500, is going to be 1 because it is the definition. So it's not a trick question, but it does kind of test whether you know what beta is. Talk about converting investments into cash liquidity, right? Talked about bond ratings. Obviously, it's multiple choice, but the letters, AAA versus BB, Anyway, look for the one with the most letters, and capitalization counts. So, talked about liability already. Another math problem regarding with investments. You invest a certain amount per month. You might want to have a calculator. It might be helpful. But again, there's not going to be formulas or any of that kind of stuff. I mean, I guess you could convert this stuff into formulas, but if you just think about it logically, you you made payments for 20 years, so 250 a month, Anyway, you just do some simple math and you'll get to where you need to be. And it's multiple choice. Proceeds for life insurance. What do you typically do with them? Well, the beneficiaries can do whatever they like. So it could go to, paying a mortgage, charity, paying taxes, lots of things. So Sometimes you have stocks that will split. Sometimes there's a fast growing company or just a company that whatever. Let's say, I showed you a couple prices like Spotify there for a while was traded up at about $1,500 a share. That's pretty large, and I've got an Amazon share too. They trade for like 3,000 a piece. It's just crazy to be that high. And so a lot of times a company will not want to have their share price that high, so they'll do some sort of stock split. Now the split doesn't actually generate any wealth from you. If you had like let's say two shares at 1,500 each, and they do a split, they split them to 750. Well, now you got four $750 shares, so you didn't necessarily make any money. But it is kind of a typical trait of companies that are fast growing. So, and that does show something. But anyway, that's what a stock split does. Um, Remember bonds, just like I said, AAA with all caps is up at the top, but default, meaning they're not paying their loans anymore, D. D is in default. So if you've got some, C-rated bonds, whatever would be junk, meaning that they'd also could be defined as high risk, high yield, because they got to pay you a ton of money because that thing's, one letter away from being in default. So they're going to have to incentivize you to invest in it. But if they quit paying their bond payments, yeah, now they're in the D category, which is default. Um, Disadvantage of real estate again, liquidity, lack of liquidity. Oh, here's something about automobile accidents. What do you do if you're in an accident? You make sure people are all right, but you don't start talking about who's at fault, who's not at fault. Not smart. Um, Number of people who own mutual funds, just huge, huge numbers, huge amounts of money. Just a general question. You won't get that wrong. So what has the greatest growth potential? And there's a list of investments. So I'll read you some choices. Bank accounts? No. It's not even going to keep up with inflation. Corporate bonds? Not not the greatest potential. Government bonds? No. Government bonds are very secure, so they're going to be a little bit above bank accounts, but not much better. And T-bills are also government bonds, so those aren't going to keep up with inflation. Then there's this one last choice, common stock. And what do we say about common stock? Not all stocks, but overall, the broad range can go up about 10% per year. And so there's going to be years, maybe the next few years that are not going to hit 10%, but then there's going to be some whopping years, down the road. So common stock would be the best potential. Another one about liquidity in real estate. So if you don't understand that real estate is not a liquid asset, you're going to get penalized heavily. Yep, more about inflation. Question that there's always a chance your investment may not keep up. It'd be tough to find an investment that would keep up. We talked about life insurance. We talked about term insurance. Remember, term insurance is very simple. You pay for a specific term. If you die within that term, you get the money. If you don't die within that term, you walk away. The benefits of that is it's just as easy as that to explain, very inexpensive, and typically no agents or commissions involved. There's no guarantee that mutual funds will get a higher rate of return than stocks. If you are lucky and you guess the correct stocks, you can probably do quite a bit better than mutual funds. But the reason why you buy mutual funds is to get that diversification. So, but this is one of those questions where it says which of the following statements is false, and the false statement would be something about mutual funds are going to yield at a higher rate than stocks. No, that's not typical and not likely. We talked about bonds, what bonds are. So if you own stock in a company, you have an equity position. You own a portion of that company. If you have a bond from a company, that's just a loan. That's just debt capital. You're loaning that company, corporation, municipality, whoever, money. Who has the greatest need for life insurance? So would it be some single person? Probably not. Would it maybe be somebody with children, as in people depending upon them? Probably so. Is Social Security going to set you up for life? No. Nope. And we talked about different types of insurance coverage. We had collision. Remember, collision covers your vehicle damage when you're at fault. Liability just covers the other person. And then kind of the catch-all was comprehensive. Comprehensive covers all the, the windshields, vandalism, all that kind of stuff. So anyway, that's the extent of the test questions that are on there. Again, I think it's pretty straightforward. You'll have 90 minutes. You'll take it through the e-learning. It'll show up on Blackboard, but just go through the instructions that are laid out in the syllabus for that. If you have any questions, let me know. You need to get your homework and all that stuff turned in. If you go back through, look and see if you're missing anything. It's not too late to turn in stuff, projects and stuff. And I'll try and get the rest of that stuff graded out this weekend. Good luck. Yeah.